Now with inflation moving closer to our goal, we need to balance the risk to achieving both sides of our dual mandate when determining the appropriate stance of policy. It would be a mistake to move rates down too soon or too quickly without sufficient evidence that inflation was on a sustainable and timely path back to 2%. Doing so would undermine all of the good work that has gone into getting inflation to this point. On the other hand, if year-ahead inflation expectations continue to decline, maintaining the current level of the nominal Fed funds rate for too long would effectively be a tightening in our policy stance, which would pose an increasing risk to the maximum employment part of our mandate. Risk management will be the hallmark of monetary policy decisions going forward. Our job is to calibrate monetary policy to the evolving outlook and the risks around the outlook so that inflation returns sustainably to our 2% goal and labor markets remain healthy. My baseline forecast is that output and employment will moderate this year, and inflation will continue to move closer to our 2% goal over time. But there are a number of risks around that forecast. Heightened geopolitical tensions have potential implications for financial markets, oil prices, and global demand and supply. A continued easing in financial conditions could spur activity, leading once again to imbalances that fuel inflation. The stress generated by the bank failures last March has subsided. Many banks have diversified their sources of liquidity, making them less vulnerable. But stress could come again to banks that continue to rely on uninsured deposits for their funding while having sizable exposures to CRE assets that will need to be repriced at higher interest rates. Now, monetary policy transmits to the broader economy by affecting overall financial conditions, but the magnitude, speed, and duration with which it affects the economy vary with the nature of the shocks that have hit the economy and other aspects of the economic environment. So while labor markets are currently strong and are expected only to gradually moderate, we need to remain attentive to the possibility that conditions could deteriorate faster than expected. On the other hand, the strong output and employment growth could be an indication that the neutral rate of interest, which rose during the pandemic, might remain high, which would mean restrictive policy may be needed for longer to achieve our goals of price stability and maximum employment. No matter, monetary policy is in a good place from which to assess and respond to these risks of the outlook. The current strength in labor market conditions and the strong spending data give us the opportunity to keep the nominal funds rate at its current level while we gather more evidence that inflation truly is on a sustainable and timely path back to 2%. This is better than finding ourselves in a situation where we begin easing too soon, undo some of the progress we've made on inflation, potentially destabilize inflation expectations, and then have to reverse course. If the economy evolves as I expect, I think we will gain that confidence later this year, and then we can begin moving rates down. My base case is that we'll do so at a gradual pace so that we can continue to manage the risk on both sides of our mandate. Of course, if downside risks materialize, we would have the opportunity to move rates down more quickly, just as we raised rates more aggressively than usual to combat high inflation.